Welcome to WCrypto.
Hello, my friends. Welcome back to WCrypto. After the last brutal hours of Bitcoin's liquidation massacre, we've now witnessed a 13.52% drop since last Friday. At one point, we saw a 24-hour liquidation window, wiping out $1.47 billion, with $1.37 billion in longs wrecked and $105.94 million in shorts liquidated. The dip didn't just stop, it accelerated into cascading liquidations, but here we are, finding a local bottom between $87,000 and $88,000. Today I'm here to break down what happened and explain why I believe this was the bottom. I'm still fully deployed in my long positions. To protect them, I had to inject more capital and lower liquidation levels on some of my entries. My positions stretch all the way from mid-$90,000 levels up to $100,800. I've seen this game played before, and I know how it works. Most people assume institutions are buying Bitcoin to go long. That's not entirely true. Over half of them are just market makers farming volatility, not betting on Bitcoin itself. Their goal? Extract maximum yield with minimal directional risk. Here's how it works. A market maker sitting on $100 million doesn't just buy Bitcoin and hold. Instead, they go delta neutral, holding equal long and short positions, so their nominal exposure remains $100 million, regardless of price action. They start by buying $50 million in spot Bitcoin, which makes them long. Then they sell $50 million in futures, which makes them short. This eliminates price risk while allowing them to farm the funding premiums paid by traders. And these premiums? They're massive. In traditional finance, volatility arbitrage yields around 10 to 20% APY. In DeFi, that number can skyrocket to 60% APY, depending on volatility. Compare that to US Treasuries yielding 4%, and it's easy to see why market makers flock to Bitcoin. But the game doesn't stop there. If market makers want to maximize profits, they don't just close positions. They manipulate the market to create forced selling events. Instead of unwinding by closing shorts, they sell spot Bitcoin aggressively first, driving the price lower. As liquidations cascade, their short positions become even more profitable. Once weak hands get liquidated, they reset their delta neutral positions at the new lows, now collecting even higher funding rates from trapped traders. This explains why, despite $38.6 billion flowing into Bitcoin ETFs since January, only $17.5 billion, 44%, is from real long-term investment. The rest is institutional arbitrage, paired with short Bitcoin futures. They aren't buying, they're farming. But here's the bigger picture. This doesn't change the Bitcoin thesis. Despite the short-term gains, global liquidity is expanding. Quantitative easing is back. Central banks are flooding markets with liquidity, and Bitcoin has finally caught up to global liquidity trends. Every time M2 money supply expands, Bitcoin eventually follows. Bitcoin has already proven time and time again that these shakeout pullbacks are part of the bull cycle structure. From the November 2022 bottom at $15,354, Bitcoin ran all the way to $108,000, with 5 pullbacks greater than 20% along the way. Each one looked like the end, yet each time, Bitcoin made new highs. The pattern is clear. Bears think this is over, but I believe they are about to get trapped. I'll keep you updated daily. Join the free Discord for live market insights, trade setups, and deep dives into the data. Like the video if you found value. Subscribe and click the bell to stay ahead of the game. And see you in the next one.